This question tests knowledge of a capital asset pricing model CAPM, which estimates the required or expected return on an investment based on its systematic risk beta. Students must identify the three key inputs. Risk-free rate RF equals 2% expected market return RM equals 8% beta equals 1.8. The expression is market return minus risk-free rate, called the market risk premium, representing the additional return investors require for investing in the market instead of a risk-free asset. First, calculate the market risk premium. 8%-2% equals 6%. Then multiply by beta. 1.8 by 6% equals 10.8%. Finally, add the risk-free rate. 2% plus 10.8% equals 12.8%. Therefore, the stock should provide an expected return of 12.8% to compensate investors for its above-average market risk. Choice analysis. A. 10.8%. Incorrect. This equals beta times market risk premium only and forgets to add the risk-free rate. B. 12.8%. Correct. Using CAPM. 2% plus 1.8, 8% to 2%. Equals 2% plus 10.8% equals 12.8%. This is the appropriate risk-adjusted expected return. C. 16.4%. Incorrect. This results from an incorrect application of the CAPM formula or a calculation error. D. 20%. Incorrect. This significantly overstates the required return and is not supported by the CAPM inputs. Correct answer. B. 12.8%. Exam tip. Remember the CAPM equation, expected return equals risk-free rate plus beta times market return minus risk-free rate. A beta greater than 1 indicates higher systematic risk than the market, so the required return should exceed the market return when the market risk premium is positive. This question examines the factors that influence a company's beta symbol, a measure of systematic risk in the capital asset pricing model, CAPM. Beta measures how sensitive a company's stock return is to changes in the overall market. A beta greater than 1 indicates higher volatility than the market, while a beta less than 1 indicates lower market risk. To answer the question, students should understand what drives systematic risk. Factors that increase the volatility of a company's earnings or cash flows relative to the market generally increase beta. These include financial leverage, debt, operating leverage, fixed costs, and industry characteristics, such as cyclicality and competition. In contrast, dividend or payout policy mainly concerns the distribution of earnings and has little direct effect on systematic risk. The question asks for the factor with the least impact on beta, requiring conceptual understanding rather than numerical calculation. Choice analysis. A. Debt-to-equity ratio. Incorrect. Higher financial leverage increases the company's fixed financing obligations, making earnings more volatile and generally increasing beta. B. Industry characteristics. Incorrect. Companies operating in cyclical or high-growth industries typically have higher systematic risk and therefore higher betas than firms in stable industries. C. Operating leverage. Incorrect. A company with high fixed operating costs experiences greater fluctuations in profits as sales change, increasing business risk and beta. D. Payout ratio. Correct. The payout ratio reflects the proportion of earnings distributed as dividends rather than retained. While it may influence investor preferences or growth opportunities, it has little direct impact on the company's systematic market risk beta. Correct answer. D. Payout ratio. Exam tip. Beta is primarily affected by business risk, financial risk, and industry risk. Dividend policy or payout ratio generally does not materially change a firm's exposure to market movements, making it the least influential factor on beta. This question tests understanding of beta symbol, a fundamental concept in the capital asset pricing model, CAPM, and portfolio management. Beta measures a stock's systematic risk, or how sensitive its returns are to movements in the overall market. A beta of 1.0 means the stock is expected to move in line with the market portfolio. If the market rises by 5%, the stock is expected to rise by approximately 5%. If the market falls by 5%, the stock is expected to decline by roughly the same amount. Therefore, The stock has average market risk, neither more nor less volatile than the market as a whole. Students should distinguish systematic risk from total volatility. A beta of 1.0 does not imply low risk or price stability. It simply indicates that the stock's movements mirror those of the market. Under CAPM, a stock with beta equal to 1 should earn approximately the market's expected return. Choice analysis. A. Return should equal the risk-free rate. Incorrect. The risk-free rate applies to investments with virtually no risk, beta equals 0. A stock with beta equals 1.0 should earn more than the risk-free rate because it carries market risk. B. Price is relatively stable. Incorrect. A beta of 1.0 does not mean the stock price is stable. It means the stock fluctuates about as much as the overall market. C. Expected return should approximate the overall market. Correct. Under CAPM, a stock with beta equals 1.0 has average systematic risk, so its expected return should be approximately equal to the expected market return. D. Volatility is low. Incorrect. A beta of 1.0 indicates average market volatility, not low volatility. Stocks with betas below 1.0 generally exhibit lower market sensitivity. Correct answer, C. Expected return should approximate the overall market. Exam tip, remember the beta benchmarks. Beta equals 1 moves with the market, beta 1 is more sensitive than the market, and beta 1 is less sensitive. A beta of 0 corresponds to a risk-free asset. This question examines the concept of interest rate risk for corporate bonds. Interest rate risk refers to the possibility that a bond's market value will change because of fluctuations in market interest rates. When interest rates rise, bond prices fall, and vice versa. The key issue is identifying the best measure of a bond's sensitivity to interest rate changes. While several bond characteristics are related to risk, duration is the most comprehensive measure because it considers the timing and present value of all future cash flows, including coupon payments and principal repayment. Duration estimates the percentage change in a bond's price for a given change in interest rates, making it a widely used tool in bond portfolio management. Students should distinguish between maturity, which measures only the time until principal repayment, and duration, which measures the effective weighted average timing of cash flows and therefore captures true interest rate sensitivity. Choice analysis. A. Duration, correct. Duration is the best measure of interest rate risk because it estimates how much a bond's price will change when market interest rates change. Bonds with longer durations are more sensitive to interest rate movements. B. Yield to maturity, incorrect. Yield to maturity represents the bond's expected annual return if held until maturity, but it does not directly measure price sensitivity to changing interest rates. C. Bond rating, incorrect. Bond ratings assess credit risk, or the likelihood of default, rather than interest rate risk. D. Maturity, incorrect. Although longer maturities generally imply greater interest rate risk, maturity ignores coupon payments and does not measure price sensitivity as accurately as duration. Correct answer, A. Duration. Exam tip, remember that duration is the primary measure of interest rate risk. While maturity provides a rough indication of sensitivity, duration is superior because it incorporates both the timing and size of all bond cash flows, making it the preferred tool for managing bond portfolios and assessing interest rate exposure.